Even though we're seeing a little red today and October overall has been more volatile than investors would like, year to date the markets have still been on fire. There's green everywhere and Wall Street are saying the good vibes are officially back. And if you're an Amazon shareholder, well, you definitely felt those good vibes after their strong earnings yesterday. But here's the flip side, with major indexes breaking new records and hitting fresh highs, stock valuations are becoming more and more stretched and in even some cases potentially overvalued. We're seeing it not just in the price action, but even when we look at the PG ratio that also incorporates high growth that a lot of these companies are anticipated to execute on. And at the same time, CapEx spending keeps pushing higher and higher, and the AI boom or bubble, depending on who you ask, has become a growing concern for a lot of investors. And we also got a rate cut this week, something the markets do love, but there's still no clear indication we're gonna see another one before 2026. And whilst the US and China meeting was positive, helped keep momentum going, the truth is October as a whole has been very mixed. So with uncertainty rising, valuation stretch, it's more important than ever to be very selective, and that is why today we're looking at 10 must-buy stocks for November, strong companies with real upside potential that you may want to consider adding to your portfolio before the rally continues. Now we're going to run through 10 of these very briefly, looking at the valuation as well as our own intrinsic price. Kicking it off with S&P Global. Now they're up only 1% over the last year. Year to date they're flat, but if we zoom out to the last 10 years, massively outperformed the S&P, up nearly 400%, trading roughly around the mid to lower end of the 52-week range. We can see 52-week high, $579, where we get a buy rating from Seeker Alpha, but Wall Street themselves are calling S&P Global a strong buy today. And if we look at the forward P, it sits at 26.8. That is well below their historical 30 and one of the lowest it has been in the last 5 years. In fact, the lowest forward P did sit around 24.5. We're talking around 2022. And this is also confirmed when we take a look at the blue tunnel. Remember, newer viewers, in fact, this signifies the expected value or the intrinsic price. We're seeing it just outside the bottom end. That is why we talk about undervaluation possibilities, something also noted during Liberation Day. Otherwise, in fact, this company does tend to trade in a reasonable value. And if we zoom out to the last 10 years, what's very fascinating that we want to point out, this company rarely, if ever, trades severely undervalued. There aren't many instances where you can see this trading below the bottom end. And this is always, looking back at history, a great time to consider SPGI. And before we run through our discounted cash flow, we want to reflect on the valuation grading of an F. Now ultimately they are trading at a 163% premium to the sector overall. We just want to flag in this sector there are many poor quality companies, which does drag this average down to around 11. More importantly, against their own 5-year average, as we did just flag, they're trading at a discount. Now you may want to look at a PG basis. Doesn't essentially seem reasonable for companies that aren't growing at a very rapid rate, but we'll flag it nonetheless where it sits at 2.6, a 138% premium to the sector. More importantly, on a PG basis, they're actually trading at around a 12% premium than their historical rate. And as we said, for each one of these companies, we want to reflect on our own price, which gets to $648. This is derived solely from the discounted cash flow model, where you can see we've used a growth rate of 12%. In fact, the last 2 years, very high, 42 and 56% respectively. And you'll note a low, medium and high, 10, 12, 14. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, S&P Global or any others. But first things first, before we even kick off, one of the most important takeaways here is that on a reverse DCF for S&P Global, 8.2% growth is baked in to the future free cash flow. So you may look at this already and say severely undervalued, potentially, if you believe they can grow faster than 8.2% moving forwards. Vice versa, if you see this as too high, then potentially overvalued. So we get the growth rate with the discount rate to give us the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get to the equity value, and divide by the shares outstanding, getting to 647, indicating 33% upside. Now you may look at this and believe it is too optimistic. Well look, and for transparency, at 10% it comes to 557, still upside of 14%. If you believe we're being too conservative, well look, at 14%, $750, 54% upside. Now we're not done there, because typically we like to use the middle rate to search for a margin of safety. 10% is what we kick off with execute buy if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, which would be a buy up to $583, but the model is flagging to us now we are getting a 25% margin of safety today. Wall Street themselves also like it. We just heard they've given this a strong buy rating. 620 is what they estimate the price to be into next year, 27% upside. So let us know your views on S&P Global, stock number 1, whether you see this as a buy, hold, or avoid. We'll also show, for those that want to see the lower rate at 10%, you are getting a margin of safety, but clearly to a much lower degree at 12%. And for completeness, at 14%, the higher growth rate, you are getting a 35% margin of safety. Before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone on the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. We're dropping November's copy tomorrow, so it is imperative that you are signed up today to make sure you get that straight in your inbox. And we cover lots of information for each of these companies, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're covering is Meta Platforms. Now this one is up 11% over the last year. Year to date, with the drop that we saw just yesterday after their earnings, they're up 13%. But over the last 10, this is one that has still massively outperformed the S&P, trading as of today at the midpoint of the 52-week range. Like S&P Global, we get a strong buy rating from Wall Street and a respectable buy from Seeking Alpha. And we've incorporated this one in the episode today, even though we looked at this in depth yesterday, because we can see this data refreshed, which means the forward P now sits at 22, below the 5-year average of 23. Again, this is what we could consider potential undervaluation. And likewise, when we look at the blue tunnel now, we are seeing it right there towards the bottom end, another potentially undervalued point, although you will notice it's only once in the last year been below, during Liberation Day. In fact, before that, at the beginning of 2025, it was trading at a premium, like it has done quite a lot during this summer. And if we extend to the last 10 years, well, I'm sure this one is famous, in fact, for having such a massive drawdown, trading below $100 not that long ago. So clear and obvious that more often than not, this one actually does trade at a discount overall, where they get an F on their valuation grading. Although the main takeaway that we want to point out, as it is refreshed from the episode yesterday, PG 1.58, now sitting in line with the sector, which, as we said, for most of these companies that we're covering, they are very high quality. So actually to be in line with the sector does show you how cheap this one could be, and pretty much a PG basis in line with their 5-year historical. And our intrinsic value is unchanged from yesterday at $800, where in fact what we're seeing, a growth rate of 12%, does indicate the 800 value, which is 21% upside, and we're trying to be a bit more conservative on this company. 12%, 21 could look very attractive. Reverse DCF today, we're talking 9.3%. So using the lower growth rate today, given the drop, you're now getting an 18% margin of safety. Wall Street still very bullish, strong buy rating, $880 into next year. That is 33% upside. And in fact, if we were to use the middle rate, as we consistently do at 14% for Meta, well then you are in fact getting a 28% margin of safety, intrinsic price nearer to Wall Street's target. So let us know, stock number 2, whether you see Meta Platforms now as a screaming buy, hold, or maybe complete avoid. The next stock is Automatic Data Processing, down 11% in the last year, down 11 again year to date, but over the last 10 years, marginally outperformed the S&P, trading today at a 52-week low, Pullback from their highs of $330. Very weak buy rating though from Seeking Alpha of 3.5. That is the bare minimum to see this rating. Wall Street and Quant do give it a hold. Where we notice is trading at a 5-year low in terms of forward valuation, 23.4, below historical 28.6. And we also get that severe undervaluation signal for the first time in the last year for ADP. Very rare occurrence to note, of which when we zoom out to the last 10 years, it does make that in fact even clearer. This one is a high quality company that very rarely we can see around the COVID drop where it did come below, comes into that undervaluation signal. So another one if you've got your eye on to maybe consider at this price point. And a D plus on the valuation grade, 16% premium to the sector overall, 18% discount to their 5-year. Price to earnings growth 2.66, so it is at a premium to the sector, and a very slight premium of 6% to their 5-year average, which sits at 2.5. And our intrinsic value comes to $316, the average of the 3 models. If you solely wanted to pick out the DCF model, well, $353, where we've used a growth rate of 9%, that is below the average at 12, below their most recent of 20%, and baked in is 4.8%. Again, might give you a starting indicator as to whether you should consider, and we can see 18% in terms of a margin of safety. Wall Street see 310 into next year, 19% upside, and if you wanted 25% MOS, well, a buy if it gets there at $237. So let us know your views on automatic data processing. And then we move on to Mondelez, down 17% over the last year, down 5% year to date. Over the last 10 years, not great at all. The first one today that has underperformed the S&P, trading very near to its 52-week low like we saw from ADP, but unlike that company, we also note a respectable buy rating from Wall Street at 4.15, and it's trading at one of its lowest forward P valuations over the last 5 at 18.7, historically average at 21. Yield is also the highest it's offered investors at 3.5 than the 5-year average at 2.4, and we can also note that undervaluation signal, it does sit just below the bottom end, something very rare to see in the last 12 months. And in fact, zooming out to the last 10 years, again, not very often. There was a stretch of a year or so, 2018 to 2019, where it was severely undervalued, but otherwise does tend to trade within the reasonable parameter. And a D plus on the grading, trading at a 26% premium to the sector, a discount to their 5-year average. Price to earnings growth if you want to incorporate it, but maybe one of those companies that it isn't most applicable to, coming in at 9.7, above both sector as well as their 5-year at 4. And our intrinsic price, $69, although you can see DCF quite some way below at 61, where baked in is 7.3%. We have used a growth rate of 8%, pretty much in line with their 5-year average, where $69 does in fact arrive at an 18% margin of safety. Wall Street themselves see $71 into next year, 25% upside. If you wanted 25% in terms of MOS, well, a buy at 52. Mondelez, fairly attractive starting yield. Let us know, buy, hold, or maybe sell. And then we move on to MasterCard, a company where you may look at this and say it's overvalued because of the high valuation, but it is a very, very strong and consistent company that always churns out very good numbers. Over the last year, it's up 7%, year to date up 4%. Over the last 10, another nice outperform of the S&P, trading around the midpoint of the 52-week range. Double buy from Seeking Alpha and Wall Street, nice respectable 4.31 as well out of 5, and it's trading at a forward P of 30, historically averages at 33. And whilst we do get a reasonable signal when we take a look here, it is pretty much right there towards the lower end, something incredibly rare over the 12 months for MasterCard as well. But actually, when we zoom out to the last 10 years, there have been only 2 instances in 2023 and the end of that same year where we got severe undervaluation. Otherwise, this is one that quietly trades within the blue parameters, or in fact an extended period at a massive premium. Now, an F on the valuation, as they're trading at a very large premium to the sector overall, a discount as we just highlighted to their 5-year average. Price to earnings growth 2.3, that is a premium to the sector. Historically, it's been around the 2 mark, so in fact, as of today, there is a slight premium. And our intrinsic price at $637 derived from the DCF is using a growth rate of 14, which is lower than the average and lower than the most recent increase. On a reverse basis, 11.8 for a company like MasterCard, maybe one to seriously consider. but using the middle rate, you are getting 16% upside, and with that, a 14% MOS. Wall Street themselves see $650 into next year, that is 19% upside, and if you wanted to see at 20%, one to consider at 509, at 25, 478. We'll also highlight that if you do use the average over the last 10 years of 16%, then in fact you are getting a margin of safety at around 25-26%, which is typically where we would say a company of a high quality caliber like MasterCard is one to consider as a dollar cost average. We then move on to Booking Holdings, up 8% over the last year, up 2% year to date. Over the last 10, it has marginally outperformed the S&P. As of today, trading at the midpoint of the 52-week range. Another double buy with Wall Street being respectable at 4.25 out of 5. We also see a forward P below 20, historically at 22.2. And in fact, we can see it right there towards the bottom end, very similar to MasterCard over the last year. This one very rarely trading below the bottom line. And over the last 10 years, the conclusion does for the most part hold true. 2023, we can see there it was severely undervalued. Otherwise, we can note it is trading within the parameters of the blue tunnel, and it gets an F overall, 33% premium to the sector, 44% discount to their 5-year, but what makes it look incredibly attractive, price to earnings growth 1.3, 19% discount to their sector, and against their 5-year average, a 27% one. Now, our intrinsic price just below $6,000 is derived using a growth rate of 6%, just in the last 2 years, back-to-back double-digit 13, and on a reverse basis, 3.8, no matter which one you use, although 4 in fact does give minimal upside, but you can see this company is starting to look very attractive, especially if you believe these numbers are very conservative, but using the middle rate, you are getting a 15% MOS, at 20%, a buy at 4769, and at 25, 4472. Wall Street themselves see 6185 into next year, 22% upside, and if you believe these numbers are a bit of a joke, well look, at 8% you are in fact getting a 26% margin of safety. So let us know your views on Booking Holdings today. And then we move on to the company that can't seem to catch a break. Novo Nordisk down 57% over the last year, 43 year to date. Over the last 10, up 79%. Massive downward spiral from their highs last summer, and is now trading very close to its 52-week low. We also get a double buy from Seeking Alpha and Wall Street, although both of them on the weaker side, and is trading at a forward P 13.1, not only significantly below the average of 30.4, but the lowest at least in the last 5 years. This is the data set we have available, with a yield of 3.6%, not only the highest in the last 5 years, well above the 5-year at 1.4, and we also note a very safe 90 score on the dividend safety, and this one does historically grow those dividends at a very attractive rate, and another confirmation of potentially severe undervaluation. The intrinsic price or fair value has been constant over the year, whilst the share price has deteriorated very significantly. This disparity is absolutely huge on the bottom end. Again, this is where potentially screaming buy opportunities do show themselves, of which a B- is noted on the valuation, 25% discount to the sector, 55% discount to their 5-year. Price to earnings growth is now sitting below 2, pretty much in line with the sector, and now a discount to their 5-year at 12%. And our intrinsic value does come to 2 different price points, $46 or in fact $72. This ultimately does come down to whether you believe the cut that they did to their free cash flow outlook is something that will be over the longer term. If you believe that is the case, well then on a reverse DCF, 12.7% is already baked into the numbers, and actually as of today you are paying a 5% premium. If you believe that no, in fact, the issues the company face is just short term and medium to long they will be fine, well, using their original guidance, we see on a reverse DCF 5.7%, meaning a 34% margin of safety, and on both accounts Wall Street see around $68 into next year, very bullish with a 42% projected upside. Let us know, but even if we do take the more optimistic outlook and we lower their growth rate moving forwards to 10%, you are in fact still getting a fairly decent MOS at 24. NVO though, in your view, is it a buy, hold, or maybe complete avoid? And then we move on to Waste Management, finally below $200, down 7% in the last year, pretty much flat year to date. Over the last 10 though, it has outperformed the S&P, trading pretty much at its 52-week low with a singular buy rating from Wall Street at 4.04, and we notice the forward P pretty much in line with the lowest over the last 5 years at 24.9, historically sat at 27.6, and we also get now for the first time in the last year Waste Management potentially severely undervalued. Zooming out to the last 10 years, in fact not once have we seen this come below the bottom end, a very rare sight indeed. Now they do get a D on the grading, 30% premium against the sector, 7 to 8% discount against their 5-year. Price to earnings growth 2.5. Yes, it is above the sector, but actually historically PG for Waste Management was 2.8, hence you can see a 10% discount. And our intrinsic value 221, although we'll flag on a DCF, it does come lower at 178, where we've used 12% moving forwards, which is below 2024 at 18, although above the average. Reverse though, you can see fairly high at 13.4. Now incorporating all of these models, we get to 221, meaning a 10% MOS, something we haven't seen in many years for Waste Management. If you wanted 20%, well, I'd buy at 177, and at 25, 166, with Wall Street today believing this company will hit $250 into next year. That is upside of 26%. Waste Management, is it now a screaming buy? We then move into Eleven's Health, down 22% over the last year, 14 year to date, over the last 10, up 137. Downward trend though, since last summer at $557, trading near the 52-week low. Double buy again with Wall Street respectable at 4.14 and a forward P of 11.5 below historical 13.8, although it did dip not that long ago into the single digit. You're also getting a yield 2.2% above 1.2 on the 5-year, and we can also note severe undervaluation, although this has pretty much been true over the last 12 months for ELV. And zooming out to the last 10, again another one that very rarely until 2025 traded for a long period in this undervaluation signal, where we're noticing a B- on the grading, 42% discount to the sector, 25 discount to the 5-year average, and then our intrinsic value gets to $401. DCF does come quite some way lower, where we've used 5% moving forwards. Baked in today is 4.3, but on average you are getting now a 20% MOS. Wall Street sees 395, pretty much in line with our intrinsic price, so 23% upside into 2026. 25% MOS would be a buy around the $300 mark. ELV, let us know if this is one to get excited. Is it a screaming buy? And then we move into the railroad industry with UNP down 6% in the last year, down 4 year to date. Over the last 10, up 154, trading towards the low end of the 52-week range. Another double buy with Wall Street respectfully at 4.1, and we notice a forward P below 18, historically a little bit higher at 20, with the yield edging above the 5-year, 2.5 versus 2.3, and we also get that undervaluation signal, something we've noted only a few times in the last 12 months. Otherwise, when we do zoom out to the last 10 years, again, another company like the most today that very rarely show themselves as severely undervalued, and they do get a C on the grading, 9% discount to the sector, 10% discount to their 5-year, price to earnings growth at 2.4, 27% premium to the sector, also a premium to their 5-year at 14%, where our intrinsic price of $247 isn't too dissimilar from the DCF. We've used 9% below the 2024 at 23, in line with their 10-year, and we can see on a reverse DCF 7.6, which does mean today you're getting a 12% MOS. If you want a 20, a buy at 197, and at 25, 185. Wall Street themselves see 265 into next year, translating to 22% upside. So is Union Pacific the railroad that will get you excited to consider for your portfolio? And then we move on to Intuit, up 6% in the last year, up 5 year to date. Over the last 10, massively outperformed the S&P, trading around the mid to lower end of the 52-week range. One very respectable buy from Wall Street at 4.3. Forward P as well, 28, below the historical 34. That is an undervaluation signal, of which when we look at over the last year, we have seen this quite a number of occasions pop just below the bottom line. Zooming out though, over the last 10 years, they have gone through periods both undervalued as well as trading at massive premiums. And the grading, which does come to an F, means you're paying a 10 to 11% premium to the sector, massive 25% discount to their 5-year average, PEG 2.12, not too bad, 20% premium to the sector, 10% discount to their historical, and our intrinsic price, just under $800, is derived using the middle rate of 12, which is below both average of 24 and their most recent year of 30%, baked in now below 10%, sitting at 9.2. So middle rate of 12, which as always, you can grab a copy of this model by clicking on the pinned comment below, gives rise to an 18% MOS. If you wanted 25, well, a buy at 598, and Wall Street fairly bullish, $835 into next year, 28% upside. If you wanted to see this at a more conservative look at 10%, then you are getting a margin of safety, but much smaller at 6, and likewise for completeness for Intuit at 14%, a 29% MOS. So let us know your views on Intuit as well as the others we've covered today. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.